Hi everyone, this is Robert with goldsilverpros.com, and this is your weekly market wrap-up for February 3rd, 2019. I'll start off by looking at the stock markets. It looks like they're up about 2%. Actually, they were up about 3% on the week, but we've seen some of the aftermarket trading numbers come in. But it's about, between 2 and 3% for most of the major markets. Certainly a solid up in the last month since we started the new year. Looking pretty good. It looks like we're correcting back to maybe where, or getting closer to where we were before we had the big correction in Q4 of 2018 that I spent a lot of time documenting. So it looks like the market thinks we're in good shape. The main headlines were that we've had something like 100 straight months of job gains, and the jobs report, non-farm payroll report, came out very positive, 300K print. Of course, in the fine print of that was that last month's jobs were actually 100K lower than what they originally reported, and this happens quite a bit if you don't follow the jobs numbers. They'll come out with a big rosy print, makes everything look great, and this has been going on for over a decade, as long as I've been following these reports. They'll come out with a big print, and then the next month they'll revise it down and say, oh, we were wrong, after we went back and actually crunched the numbers. And there are reasons for that. It's a goofy way in which they calculate it. But just suffice to say, if you see a 300K print on new jobs, it's usually not 300K. It's usually somewhere between maybe 250 or something like that. And you can see that on the subsequent jobs report when it comes out the following month. So just know that those numbers are usually a little bit more rosy than what we've actually got, but it's good to see that we're creating new jobs. Unfortunately, as I've shown by looking at the Bureau of Labor Statistics chart on the total workforce participation rate, is we've actually still are in the 63% range, and in the Great Recession in 2008, 2009, we're in the 66% range. So since the Great Recession, we've actually destroyed 3% there are 3% less people actually working in the workforce. Now, how can that be when we're creating so many jobs? Well, for one, we have over 360 million people in this country, and so a 300K jobs print sounds nice, but it doesn't really put a dent by itself into the overall amount of jobs that we have to have, the amount of people we have to have working. There are tons more people that need jobs. And so you have to have a bunch of those 300K prints in a row. And again, I just discussed how they're seasonally adjusted and recalculated the next month, so it's never quite as good as they say anyway. The other thing is we have an influx from around the world of people coming into the country, and we're barely keeping new jobs up for these people as well. So that's a lot of what happens there as well. The overall percentage of adults in the country that are eligible to work and want to work is really not budging up too much from that 63% level. And that's still down from 10 years ago when we had the Great Recession, even though we've had some good jobs reports. So just keep that in mind when you're looking at those numbers and hearing that news. I'm going to look at gold today on the COMEX, and it looks like the price has gone up from about 1303, 1304 to about 1316. So pretty good recovery in gold this week. That means more money is going into the ETFs. Same thing with silver. It went from about 1560 something to about 1591, 1592. So it's gone up solidly this week, although we have not recovered from the $20 high that we saw back in 2015, 2016 timeframe. So it's nice to have this recovery, but it's really just the beginnings of a recovery. I think it's going to be part of a longer bull-term market in gold and silver, but it's just now starting to play out. So if you're worried about whether gold and silver are overpriced, just suffice it to say that they're not. And if you want more information on that, go see my articles on the website, goldsilverpros.com, and on Seeking Alpha, where I've documented the gold and silver are at inflation-adjusted lows since 1970. That is now 49 years and counting. That's right, inflation-adjusted lows since 1970. So the price is really at the low end. Don't worry about those prices now. They've got a lot of room to run to the upside, especially if we continue to have economic problems around the world. And remember, it's not just the United States that we have to look at in terms of gold and silver price. It is all over the world. If you want to know more about what drives the gold and silver price, my December and January subscriber updates, the written and the audio portions, go over that in detail. I've documented for the last 18 years and then even longer than that, over the last several generations, exactly what drives the gold and silver price. So I can tell you exactly how to calculate that and how to know what's going to happen in the gold and silver price over the short to medium term. Over the long term, I think that dynamic is actually going to change. The one we've had in place for a couple of decades, because of the worldwide financial problems, is going to break that system, and a new system is going to emerge, and gold and silver are going to be repriced. If you're interested in how that's going to happen exactly and what the catalyst will be for that, This week, I'm going to post my subscriber updates for February 2019, and that's the subject of those. I will walk through in detail exactly how that's going to work and the signs to look for when that happens. I wanted to point you guys to some interesting news articles that I saw this week. I'm on economica.com, and they were talking about where the debt is going, the national debt, in terms of what the U.S. releases in their treasuries, and who's taking on that debt. As we get higher interest rates and we get longer into this cycle, the risk goes up for holding that debt because the prices are going to come down. Remember, interest rates and prices on bonds are inverse. As the interest rates go up, you have to drop the price more to get somebody else to take that bond off your hands. So as the interest rates go up, the bonds are worth less, and it's more risk for the bondholders. This article does a really good job of showing exactly who's now holding the risk of that sovereign bond debt. So we're just going to go down and go to this chart, and you can see that the Federal Reserve has dropped from 09 to 014 is the blue chart. They've dropped this many trillion, 2 trillion, in Treasury holdings to 15 to 18. They've dropped quite a bit. The intergovernmental, which is government to government agencies, about the same. In other words, some agencies buy the other, and that's about the same as it was. The foreign holdings have gone down. So the Federal Reserve and everybody else that was holding the treasuries are selling out. And they're doing that because the risk is going up. And guess who's buying it? Domestic. Okay, so that means people in this country are buying more of our own debt. And when you hear some pundits talk about debt, they say the Federal Reserve is buying our debt. The Federal Reserve is buying our debt. And they can do that forever. And it doesn't matter. And we just buy our own debt. We owe it to ourselves. That's not true. For example, at the Vancouver Resource Investment Conference in Vancouver that I was at in the last week, it's been about I don't know, it might have been 2 weeks since I was up there. It was January 21st. One of the pundits, they had a panel talking about risk and the U.S. debt and things like that, and one of the pundits up there was saying, oh, we buy our own debt, and other countries have dumped it, and it doesn't really matter. We've been doing that for a long time. Big deal. He thinks the system can go on forever. But I don't think he's taken the time to realize who's actually taking the risk of that debt on. Yes, we are buying our own debt, but it's not the Federal Reserve, the central bank, buying the Treasury debt. It's somebody else, and that's what I wanted to talk to you about here, because this is a gigantic risk transfer. It's a risk transfer to people who have no idea what's going to happen when that bond and that debt default occurs. So who's buying that? Well, if you own mutual funds, you're buying more of this risky debt, this unpayable debt by the U.S. that nobody expects the U.S. to ever pay back unless they hyperinflate the currencies to pay it back and just print trillions and trillions of dollars. Other, well, what is other? Change in domestic holdings, other. That's other people that are buying it. It's not as much state and local. It's not insurers. It's not private investors, not the savings bonds. The banks are not. They're reducing their exposure to debt. So all the smart money, the well-heeled money, the Federal Reserve, the foreign sovereign debt holders, the banks are all dumping this debt. They're getting rid of the risk so that they don't take it when the U.S. finally defaults. The mutual funds, which, ladies and gentlemen, most people invest in their 401ks, their pension plans, and any sort of qualified investment account, and even people that just buy mutual funds within their brokerage accounts are taking on much more of that risk. That increases the default risk of all of your retirement accounts. And then there's this massive other. Well, who is this other? Let's go down in here, and they talk about it. I think I skipped it, actually. Sorry about that. Who is the other? State and local governments, mutual funds, other investors. Okay, here we go. Sorry. The other investors includes individuals, government-sponsored enterprise, Freddie Mac, Fannie Mae. That's why Freddie Mac and Fannie Mae, they're talking about taking them private again, because it's just a mess, and they're not worth anything right now. Broker-dealers, again, putting it into the mutual funds. Bank personal trusts and estates. That's personal trusts and estates, not bank-owned. And corporate and non-corporate businesses. And so there's all of this is being taken on, essentially. It's being moved out of the banking system. It's being moved out of the central bank, the Federal Reserve. The other sovereigns, China and Russia and all those other people, the European nations that used to own a lot of our debt, are dumping it. And it's all being packed into mutual funds, individual investors, government-sponsored enterprises which are insolvent. So basically, Freddie Mac, Fannie Mae, they're bust already, and they're taking on more of this junk, and they're just going to have to be bailed out because it's going to be part of the bailout. Broker-dealers, bank personal trusts and estates. So when you set up a trust with your bank, they're like, hey, go buy this debt. It's so safe. Well, it's not really. So all of that risk is going to be borne by the people of the country. It's not going to be borne by other countries. It's not going to be borne by our central bank. All of that risk has now been shifted into the hands of the people, and that's going to bankrupt the people when the crash comes. Another thing I want to talk about is not only that bonds are not a safe place to put your money, but if you're going to have your money in a 401k and invested in stocks, well, guess what happened? Here's an article by Yahoo Finance. The number of 401k millionaires fell precipitously in the fourth quarter of 2018 amid increased market volatility after December registered the worst month for stocks since 1931. So that correction that we had in the fourth quarter, which actually started at the end of September and in October and peaked in December, basically destroyed a lot of wealth in 401k retirement plans. And guess how many more years you're going to have to work to recover that? Because I will tell you, we're in a 10-year bull market. We were in a 10-year bull stock market that corrected, and now technically I would say we're going to see what happens for the next year to say if we're officially in a recession and in a bear stock market, or whether we're going to resume that bull market. I don't think we're resuming that bull market for the previous mentioned issue of the debt, and I don't think it's possible to resume a strong bull market with that much debt all over the place. So if you thought you were doing well in your 401k and you just dropped below the $1 million mark and you can't retire anymore, and you're in the several hundred thousands, and all of that wealth just disappeared, you have to ask yourself, is that a safe place to put your money? And is buying and holding over the long term in the stock market with that volatility, with it being up and down, a good place to hold your money? And how do you know that it's going to be there when you need it? And how are you going to be able to keep up that wealth that you thought that you had? Last thing I wanted to talk about, there's an article on Zero Hedge talking about, this is from Bank of America. It says a typical professional investor is focused on momentum, is unused to volatility, and sees valuation as irrelevant. In other words, they don't look at the value of their investment. Okay, that's why you have this situation going on. That's why you have market crashes, because everything's overvalued, and when it crashes and comes back down to valuation, whose wealth does that destroy? It destroys the people who have their money in the markets. And it says they're focused on momentum. It's sentiment. It's, ride the wave. It's follow the herd. It's what is everybody else doing. Does that sound familiar, ladies and gentlemen? If you remember the 2008-2009 time frame, that's exactly what was occurring. It was follow the herd. It's the bull market. It's don't worry what's going on. It's all good. Maybe just put your money in, and then we had the big crash. Well, Bank of America is saying that's what investors are doing now. They're not paying attention to valuations. They're not seeing that the market's overvalued. They're sticking with the momentum, meaning they're continuing to pile money in there. And they're unused to volatility. That's why the fourth quarter volatility that we saw in the prices really shocked people. Not only did it destroy account value, but it really shocked people because they're not used to it. And this report basically goes on to say when that volatility increases, there's a lot of people that's going to get hurt, and they see rising volatility for the foreseeable future. And they think that there's going to be additional issues with the stock and bond markets, what this report is saying. So it doesn't look like right now is the time to have your money in bonds or in stocks when Bank of America, among others, are saying that the volatility and the pressure and the risk is going up. And where you really want to put your money is in gold and silver, and that's why gold and silver are getting bids, because a lot of the smart money is starting to move into gold and silver, at least in the form of the ETFs, if not the physical quite yet. So that's why I wanted to focus on for this week. Even though we have a very small stock market recovery underneath the surface, we've got a lot of issues. We still have not recovered the jobs that we had in 2008, 2009. The jobs prints are not actually accurate. You have to follow them over time, and they revise them down. Just remember that. The debt risk is being forced onto the consumer and the individual owner, and the smart money is getting out of it. The sovereigns are getting out of it. The Federal Reserve is getting out of it. The 401ks are starting to crash. It's increasing volatility, and people don't know what to do because all they do is focus on momentum. They don't bother valuing their investments, and they're unused to volatility. That's the theme for this week. Thank you guys so much. Please subscribe to this channel and go visit us on goldsilverpros.com and sign up for our newsletter.
This has been a Gold Silver Pros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.